Hello and welcome everyone. I'm Taylor Pankratz and this is Behind the Breakaway. Together with my co-host Jason Barber, this show takes you behind the scenes of leaving your captive broker-dealer firm and explores the world of RIA independence.
All opinions expressed on the podcast by the host and guests are solely their own opinions and do not reflect the opinion of Uptick Partners. This podcast is for educational purposes only and is not legal advice and should not be relied upon as a basis for any decisions.
Hey guys, we are on location at a breakaway, but given the news of LPL buying Commonwealth, we decided let's do an emergency pod. Let's have Jason Wenk, founder of Altruist, give us his view on what's going on. And so we hope you guys enjoy.
Thanks, Jason, for joining the Behind the Breakaway podcast, and really appreciate your willingness to come and join and share your thoughts on the Commonwealth and LPL merger that's happening. I thought I may tee up a few questions, but before that, I'm going to do a quick intro of you for those that are not familiar kind of with your background. So just forgive me as I just read this here real quick. Jason Wenk is the founder and CEO of Altruist, a fintech company revolutionizing the wealth management industry through its modern commission-free custodial solution for financial advisors. Prior to Altruist, Jason founded Formula Folios, an automated investment platform that grew to manage over $3.5 billion in assets, earned spots on the Inc. 500 list of America's fastest growing private companies for 5 consecutive years. A serial entrepreneur and financial industry innovator, Jason began his career as a financial advisor at a young age and quickly became frustrated with the outdated technology and high costs that hindered advisors from serving clients efficiently. This experience fueled his passion for creating technology solutions that make financial advice more accessible and affordable. Jason is a respected thought leader in wealth management and frequently shares insights on the future of financial services. So with that, thanks again, Jason, for joining, and I really appreciate it. I guess I'll just tee it up and just ask you what your general thoughts are on this news that broke with Commonwealth and LPL's acquisition of Commonwealth, rather.
Cool. Thanks for grabbing me. Whoever you got that bio from, I mean, that's my marketing team or someone else, but it was very flattering. So very kind of you.
That was Anthropic, I think, that came up with that bio.
Oh, is it? Okay, I was going to say something like that. So that's one of the more impressive read-ins I've ever had. But yes, so we obviously we were kind of speculating a little bit. I think late last week on this, you and I on LinkedIn, and that kind of all has come to fruition. Everything was kind of announced as being official this morning, including a release from LPL, and which I think is interesting because shortly after the rumors started swirling, then it was kind of like, I don't know, maybe Osaic's going to get in the mix. It's like this deal was done, so I'm not sure what kind of on that speculation. But yeah, I think look, in the end, this is, I don't know if I'd call it the icing on the cake, but sort of like there's been a trend of consolidation with independent broker dealers really going on like 20 years. I mean, when I first got into business, there were hundreds of, I'll call them like reasonably large independent broker dealers. Now there's effectively a half dozen with really just a few that are behemoths, and LPL being the kind of the biggest of them all. And Commonwealth was, I think, the last truly independent broker dealer, because I think the thing that's when the acronym is quite funny, the IBD, and if all the IBDs are technically owned or public or they're owned by private equity firms, are they really independent? And that was one that was truly independent. My understanding is like a dozen managing partners. At some point, they were going to have to seek liquidity, right? So whether that was going public or selling to private equity or being acquired, right? So I think it's like one of these things that's just a matter of time. The part that's probably extra frustrating for advisors is Commonwealth had a unique custody structure, whereas I think, I don't know what the percentage is, but an overwhelmingly large percentage of independent broker dealers historically would sit on top of Pershing for their brokerage accounts. And Commonwealth, to my knowledge, had the vast majority of their assets on a national financial broker dealer platform. And if you were a firm that was like sitting on top of Pershing, you get bought by another firm sitting on top of Pershing, it's fairly non-disruptive, right? At the end of the day, you're still working in net X360. Your clients are getting the same name on their statements. I mean, there's not a lot that's happening. For the most part, when you get bought by a self-clearing broker-dealer like LPL, I mean, you know what's coming, which is every single account is going to LPL. And so every workflow is changing. Every tools the advisor maybe had integrated with their current platform all have to be reintegrated with new platforms. It is better than most. A lot of the folks, if they've been in the RIA channel for a long time, we take for granted that we have a lot of flexibility, but independent broker-dealer reps, a lot of times they're kind of walled gardens of sorts where it's like, hey, you're independent, but you're not really independent. Yeah. Because we're going to tell you what you can use for technology, and who you can use for custody, and which money managers you might have access to, or alternatives, or et cetera, et cetera. So there's a curated kind of component. And again, all of that's then likely to change, right? Because the structure that LPL is going to use is pretty well known, and it's a huge platform, well over $1 trillion assets. So yeah, it's one of these things where I do feel bad for the initial kind of shock that probably these advisors are feeling, but I think you and I both would agree that it's a good time to actually be independent. Is probably the lesson here. In being sold from one IBD to another and being told what you can and can't do doesn't feel very independent.
I couldn't agree with you more. I oftentimes draw the analogy, and maybe it's not the best analogy, but draw an analogy of you're in prison. If you're an employee of a broker dealer, you're like way deep into the prison. And when you're in an independent broker dealer, it's like you're in the yard of the prison. But you can walk around a little bit, but there's still these walls that are like, you're not coming outside these walls. And basically what's happened now is that the warden said, well, you're moving prisons. Like, we're shipping you from this prison to this other one. And it's, well, maybe you should just Shawshank Redemption your way out of this thing and be fully independent in the RIA world. Yeah, right. I mean, that's the way to do it. So, question for you: what do you think about the valuation? 8x is the number that came out. I'm curious if you think that's normal, or because I guess I was thinking it's a little low, but which then made me speculate as to if that somehow is a result of, well, we're going to have to pay all these people a bunch of money to stay, or is that something to do with this $93 million SEC fee that's happening, or if you think, hey, 8x is actually like a perfectly fair price?
Yeah, and I think I doubt the regulatory concerns have had any influence on price. I think those are always disclosed in deals known about, and a lot of times there'll be a portion of the purchase price that's retained, and over the next 2 years it'll pay out any either current items or even future based on historical risks, if you will. So I don't think there's so much there. I suspect it's more the former that you mentioned. Like, I think there's probably two things influencing the valuation. I think it's that there's this is different than when you see about an RIA firm buying another RIA firm, and in that context, the owner of the RIA has the direct client relationships. They're making the decision to sell to a aggregator. And you see 99% retention. The clients come along because the advisor that had the relationship was the one who sold and got paid. Mm-hmm. In this world, these advisors, to my knowledge, are getting paid nothing, right? Like, there's no incentive for them to say, oh, I better make good on this purchase price. Like, a very large percentage of these dollars could leave, and there's really nothing outside of LPL paying retention, bonuses, forgivable loans, whatever, all the other different incentive structures. There's no other way to guarantee that these advisors are motivated to come along the deal. Mm-hmm. So there's a lot of broker dealer selling is naturally going to be at a much lower, valuation multiple. Whereas an RIA, if there was such thing as an RIA with, 285 billion, which I know there's a few of them out there, but they would probably sell for 25x or something like that. And a lot of it's because the assets are steady, and there's all sorts of incentive alignment. Mm-hmm. It's hard to know what the cost is. The other component I would speculate on, I don't know because Commonwealth is a private business, but a reasonably good chance that they'd had slow growth. And so when we think about the way that earnings multiples are calculated, it's a combination of the durability of the assets. In this case, you could put a question mark on the durability of the assets. The second portion would be how much of it's fee-based versus transaction-based. We don't know what that is exactly, the breakdown, but broker-dealer, good chance there's a meaningful transaction or even net interest income component to this, versus an RA firm who's selling on almost always a fully recurring revenue basis. And then the last would be that retention risk of the actual advisor. So I think you get all those things aligned 8 times probably doesn't feel that unusual, because I think transactional businesses, it's hard to get much more than 8 to 10 times. In this case, it mimight be, again, a slightly penal amount because of the fact that there's also some serious retention risk.
Yeah, exactly. I think that makes sense. So you think it's just, in your opinion, the reason that this is happening, because, it's kind of interesting, right? If you go, I'm not sure if it's still live, but if you go on the Commonwealth website, like I did yesterday, and there's a huge section on here about how we're the only one that's privately owned. We are proud to be private, and it goes so far as to say we will never sell. It's like we are not selling. And so just curious as to what changed, right? It's like, how do you go from that? It feels to be like so proud of it that like it's on my website, like we are not selling, we're going to remain private, to all of a sudden LP, like not only did we like not sell to Dynasty Financial, or we didn't sell to another service provider, to your point, because that would be one thing, right? If, someday Uptick Partners wants to sell to another RIA aggregator and nothing really changes, and at this point, it's like they're just providing the service. To sell to another custodian, it seems like a pretty bold, like pretty big move. And so I'm curious as to, do you truly think it's just, they just wanted liquidity? And
there's probably a time in all of our lives when we would have made statements like that. We would say, I'm never going to do this, and then, someone dangles almost $3 billion in front of you. And you also realize, I'm not getting any younger, and what are my other options? And before you know, it's like, well, maybe it's the best possible solution. And in the end, these are businesses, make business decisions. And I think that, again, maybe part of why they grew, to a few thousand advisors and had a lot of loyalty from those advisors was because of that message. But the reality is, I think advisors would be foolish to believe that kind of stuff. I mean, that'd be like literally you or I saying, never selling ever in my lifetime. It's like, someday we'll be dead. Someday we'll have no choice, right? Someday, things change, right? So I think that there can be an intent, which I believe was probably pretty honest when those words were written on that site. Hey, intent is to remain fiercely independent advocates for advisors forever. The real reality is that forever's a long time. And so I don't fault them for selling, but I think, now at the end of the day, advisors have decisions they have to make because what's on that site turned out not to be true. And, the decision is pretty straightforward. It's like, do I go to LPL? Probably a lot of people will. Or do I go to a different broker dealer? Some people probably will. Or do I say, what, maybe this is a sign of it? I think there's an awful lot of broker dealer reps, registered reps, and IRs that they've been kicking around going fully independent, starting their own RIAs, or maybe being hybrid or something like that for a long time. And this might be like the hair that breaks the camel's back. I don't fault them in the end. It's a marketing message that they probably believed to be true until it wasn't.
Exactly. So what are your thoughts on the LPL technology? I know that's what sparked this conversation, I think, was your donut post on there, and all of that, so kind of curious, because as I mentioned, I've got this other person that I'm talking to that was at Edward Jones, I think 2 years ago, went to LPL, 2 years in, is like, I'm paying the money back and breaking away to go RIA with Altruist. And primarily because the technology is so bad in his opinion. But what's ironic about that is I talked to a bunch of other people who say, well, LPL's tech, like that's what their selling point is. Our tech is so great. We invest so much money in our tech. And I just am like, how could these things be so opposite of each other?
Yeah, no, I hope I wasn't being too, forthright in kind of my views on their UI. I mean, I can't tell you as much. I've never been an LPL rep, so I can't say, well, from experience, this is how it works for me. I just kind of look at it, watch the demo videos, and kind of scratch my head a little bit. But I think, so a couple things on the platform itself. I think, so one, how they've navigated interest rate fluctuations. I mean, they've operated that business incredibly well, and the stock has performed well in reaction to that. So I think one, I think it's worth noting, like LPL is a very solid company. That's from a business perspective. Pretty big, successful companies that are not very good at technology. Like that's okay. I don't know if you've been on the Berkshire Hathaway website lately, but it hasn't changed in 30 years or whatever. So you can be very successful without having the world's most beautiful, elegant website. What I think is interesting about our industry is that technically platform businesses like LPL or like mine, we are B2B2C platforms. So we have to keep in mind that there's two users. You've got the advisor user and all of their related staff, and then there's an end client somewhere in the relationship. And so I do think we have to be a bit thoughtful about the user experience, because whether we liked it or not, there's a slew of consumer-facing brands, fintech companies, et cetera, that they have really fantastic design and very, very innovative technology. It's very easy to use. It's very fast and snappy and pleasant and so forth. I don't know that anybody would ever categorize the LPL platform in that way. It doesn't look very elegant, and doesn't look particularly snappy. And I don't know how the consumers feel about it, but I think most consumers, if they said, "Hey, how do you feel using this versus maybe something else?" they might go ahead. Leaves a bit to be desired. But I think that the notion that spending a lot of money on technology somehow makes it good is quite the misnomer. Just speaking again from experience, I can say that the Altruist platform is about 5 years old in terms of the core technology. The clearing technology is 5 years old. If for whatever reason, if we looked at our platform and said, "Oh my gosh, you know what? Times have changed and technology has moved really fast, and we need to re-architect our platform, we need to re-platform the technology itself," it would be a massive undertaking. No matter how big your team is, how much budget, just because what happens is the surface area of these platform businesses is very vast. So it's all of the account types you support, all the security types you support, all of the user personas you support. There are oftentimes thousands of screens that live within your web application, and maybe hundreds in your mobile applications. And when you do something that touches every single page, every interaction, it is a large scale deal. Now, their platform was largely built, 40 years ago or something. So it's most likely some combination of a large monolith, so one really gigantic code base that's been around for a long time, probably very stable, but not easy to change. And then over the years, they probably layered on these technology as a single service, if you will. And you want to make some changes to how elegant you opened accounts. You just change that one segment, right? You don't have to re-platform the whole thing. All of the big firms, right, they have these monoliths, their original code bases are very old, again, typically quite stable, but they'd be very hard to change. And so I think that, this is just the nature of what they have. And it's highly unlikely that anytime soon there'll be some big, massive platform enhancement, right? It's this is the platform they have. There'll be some iterations and slight improvements. Maybe the UI gets updated from time to time, but at the end of the day, it's going to be hard for them to ever innovate. We will have the same problem someday, right? So at Altruist, I'm not trying to say we're somehow immune to this. Just our day will be 20, 30 years from now. It's probably going to be a long time, and hopefully we're thoughtful about using modern architecture and evolving it along the way versus letting it get big and then being stuck in a weird spot. From what I've seen, it doesn't look all that great. We hear all the probably same things you do, advisors who break away from independent broker-dealers. And usually, in fact, we had one, a very large firm, multi-billion-dollar, one of the largest firms on LPL. And watching them react to a demo of Altruist was the craziest thing ever. They just were completely shocked that this even existed, because, again, they've been working for 20 years on the ClientWorks, the LPL platform. So
how could it be?
I think a lot of people will be surprised in not a good way when they go to see the new technology that they're going to inherit. And again, I wouldn't say that Commonwealth was they certainly were no Robin Hood in terms of their innovation and ease of use, but it was, I think, well respected in comparison to most other broker dealers.
Yeah, for sure. Well, so I'm for sure of the opinion that it's undoubtedly what you guys are doing there is the future. There's no doubt about it. And every time I ever open up an account for a client at Altruist, I'm always just blown away by how it's how could it be this easy, right? And how could it be so hard elsewhere? What you guys are doing is really incredible. And I think that anybody who's watching this video owes it to themselves at a minimum to go and do a demo with somebody and understand this is what 2020 technology looks like, and then let's go compare that against what we have or what's coming from any other, frankly, custodian. It's pretty eye opening. So I guess in the interest of time, I don't want to keep you much longer, but I think that if you're a Commonwealth advisor and you don't want to go to LPL, and in our opinion, the natural choice is, well, you should go RIA if you don't want to go to LPL. At least that's my position. What's the pitch if you want to give them the 30-second why altruist pitch?
Yeah, I might be the world's worst salesman. Yeah, so I don't have a killer pitch, but I would say, like, in like the first order I think people should do is they should obviously explore their options and understand what it means. And so, that's where I think like the work you do at Uptick can be, particularly valuable, like, because it's more than just a custodian. I think custodian is obviously a really critical part. It's the whole, like, how do I register? What are the BDs sometimes will try to scare the hell out of you. They'll be like, you never want to go run your own firm. It's way too expensive. The risks are way too high. So I think like talking to someone who's been there, done that, runs their own firms, coached advisors through it, like that's maybe step one. And I think what people will find is, I'm sure you agree, like it's not all that scary. In fact, it's quite exhilarating in a good way. Like this, like, kind of true independence is pretty awesome. And then, as the custodian, the things I can say is that, like, look, I've been in the shoes of the advisor. I started my career as an engineer turned advisor. My first experiences were in the early 2000s with TD Waterhouse, back then TD Ameritrade, now Charles Schwab. I could not believe 20 years ago that you couldn't open an account online. It seemed like the silliest thing because consumers could do that. Like you could do it on E-Trade or the Ameritrade website or even Vanguard's website. You could go online, open an account, fund your account. You didn't have to talk to anybody. You didn't have to do any paperwork. It's just online. The fact that advisors today are still doing things with DocuSign at best, waiting weeks to fund accounts when anybody in America can download the Robinhood app, connect their bank account, put $10 in it, and buy $10 worth of something and do it all in maybe 2 minutes or less. Just should share what the bar should be for advisors, not so much in like that we want to be trading whatever election betting and
sure
brackets and all that stuff. But the point more being about around the elegance and ease and simplicity. So really, that was the first principles approach we took when building Altruist was, it should be incredibly easy to onboard entire households. It should just take a couple clicks and be maybe a minute or less. The client experience should be super fast and easy, like just tap a couple buttons on a mobile app and be done. And funding the account should be just the same, like doing an ACAP, the money should show up in just a couple of days, not in weeks. And then other things that I think are first principles are like, why are advisors not allowed to trade in fractional shares? It just made no sense to me. The reason why is most of the firms, they rely very heavily on net interest income, and they rely very heavily on 12B1 fees and other type of mutual fund revenue. So they don't really want you to very easily be able to trade fractional shares. That would reduce the amount of cash in client accounts, which reduces the spread income they make, and it would allow faster adoption of individual equities and ETFs across clients of all account sizes. But these are the things. I think if they go in, they look at Altruist, they'll go, wow, like this is just how it should have always been. If you're a fiduciary trying to drive the best possible outcomes for your clients, so better outcomes and better experiences. And I go on and on about the other features. Just again, I think the general feeling that I think most advisors get is this just feels the way it's supposed to feel. And didn't realize that because it didn't exist for us. Like everything was sort of accepted as, hey, it's been this way for 20, 30 years, and everyone does it this way. And then all of a sudden we came along and just said, well, I don't know, maybe your fee billing shouldn't require a third-party software where you download a file, then you upload it, then you run a query, then you generate another file, then you upload that to your custodian, and then 4 days later, then a bunch of accounts like get busted because they had a monthly withdrawal and the cash balance. I mean, like that is the craziest stuff I've ever heard, right? That's sort of how the industry had operated. Yeah. And again, in Altruist, you just create your fee schedule, sign up to it, and it's just done. Like you don't have to monkey with it anymore. So a lot of the things that we do, just they save people a ton of time, a ton of money, drive better outcomes for clients. That's the genesis of the business. But it was all born from frustration of being an advisor and kind of scratching my head, being like, why are these things so hard? Why are things so challenging? And they really don't have to be. So anyway, that's the Altruist pitch in a nutshell. Cool,
awesome. So any inside baseball, new cool things coming, structured notes, alts, any of that kind of stuff? We're working pretty hard on alts right now. We're trying to, I think
people probably get tired of hearing me say this, but like most of the things we do, I would operate in what I refer to as first principles. When I think about something like alternatives or notes and other things like that, my mind kind of goes, well, you could do it like everyone else, or you could ask yourself, is there a better way to do that? Is there a simpler way that's more cost effective to the end client and maybe more cost effective to the advisor? And so the way we're thinking through alts is very much that way. We're going to build direct custody instead of outsourcing. We'll build direct distribution instead of just using a third-party platform. So that's currently in the works. Like literally big project for this year. A bunch of other kind of things we're working on this year. Trying to make tax management incredibly easy. A couple of incremental new releases on our way to hopefully by year end having full asset location, household level rebalancing, just ways to then automate things like daily tax loss harvesting and maximizing clients after tax returns and doing it all fully automated. I think that's kind of the other thing I'd say thematically is like we don't just build stuff the way other people build it. We kind of look at it and say, well, is there a way to do this with a very high degree of automation and precision so advisors can deliver these amazing outcomes and experiences to clients, but they don't have to work that hard to do it. They can focus more on relationship and less on keying in data or like sitting behind a computer. So those are a couple things this year. We have a bunch of AI tools that we'll be launching. Again, we've been trying to think about it more in a first principles perspective, like where can AI actually drive meaningfully better outcomes from a business owner's perspective and better outcomes for clients. And so I think there's some table stakes stuff out there that exists, like AI note-taking and a few other things like that, which is great that those things exist. Where you really want things to go in this business is in a more agentic way, which means what if you could just hire an AI agent directly inside the Altruist platform? You don't have to worry about going externally, and it replaces the need to hire human beings for certain things, or just makes the human beings you have way better, magnifies their ability to make an impact by 100x or something like that. So everything from paraplanning to analysis, tax analysis, things like that. So you'll see the first iterations of AI coming out relatively soon, and then things like alts, big project this year. And tax management is a big theme for the year. So there'll be 100 other things too, but there's a couple that are top of mind that I think people will like a lot.
Yeah.
Instruction is what we will get to, by the way, but that'll come after alts most likely. Again, we kind of looked at the notes platforms and we're like, gosh, it just seems like there might be a better way for people to be able to offer structured notes in a way that reduces the amount of hands in the cookie jar. Because right now that's the problem with a lot of these alternative asset classes and structured products is like, a lot of people want to get their hand in the mix, and like before you know it, you've reduced a lot of the end client impact. So if we can try to remove some of that friction, it'll just make it easier for advisors to kind of get direct access to products, pay less kind of in hidden kind of sneaky fees kind of in the distribution of these things, which will in the end result in better client outcomes.
Yeah, very awesome. Well, I'm really, really excited and again, honored that you were able to join us. And I think that hopefully this will prove to be very valuable for anybody that listens to it, that is thinking about going RIA. And hopefully they'll contact us and either, we can connect them with you guys or they'll go directly to you and do it that way. But I think that you guys are doing something really special there. So
you're so kind and appreciate the advocacy and the chance to jump on with you. And hopefully there's not like gigantic M&A transactions every weekend, but this was a fun one. And I'm glad it brought us together to chat today.
Yeah, absolutely. Well, thank you so much, Jason. And you have a wonderful rest of your day.
Thank you for listening. We hope you enjoyed the podcast. Please subscribe to our channel. You can find more of our episodes on YouTube, Spotify, and Apple Podcasts. And check us out at uptickpartners.com, where you can learn more about how we help breakaway advisors just like yourself find independence.